And moving on from Chipotle to Michael Kors. This is a nice little follow-up to our Coach show where we talked about Coach's great results. They had their first growth-based quarter in 8-10 quarters or something?
Something close to that.
Anyway. But Michael Kors, too, has been getting beat up. Nobody wants designer handbags, I guess, but they just reported, and it was pretty good.
Yeah, so there are some very clear similarities here between the areas where Coach saw success that we talked about and where Michael Kors has seen success with them releasing their results before the open today. First of all, this is for their fiscal 2016 third quarter. The revenue was up about 6.3% to $1.4 billion, up almost 10% in constant currency. So, they have their international segment, and obviously, like many companies, that's being hit by unfavorable currency exchange. But their retail net sales were up 11.1% year over year. They had double-digit growth in e-commerce, really big, and also a lot of new store openings. So while their comps were down about 0.9%, in constant currency, retail net sales were actually up almost 16%, and comps were up actually 2% when you exclude the currency effects. So keep in mind, with that really positive revenue growth, that the company has increased its retail store count by about 20% in the past year.
Where was all that? Because that's a big number.
They had, there's about 100 locations, a little over 100 locations making up that 20%. And I think it was, obviously a lot. They have different locations with their outlets and then their retail stores, and they also have licensing shops, like store in a store with department stores. But in terms of geographic segments, I think it was mostly in the U.S. Obviously, they're focused on their international expansion as well, which we'll get to. So I'm not
cool.
certain,
yeah, no, it's fine. So how are we talking about? How are they doing with operating margins?
Sure. So, there are other parts of the business. Their wholesale net sales and their licensing revenue were also up for the quarter. Their operating margin shrunk about 2.5 percentage points.
Is that because they kept opening more the outlet stores and stuff?
I think it's a lot of it. Yeah. I think it has to do with a bit of an investment in terms of what they're putting into their e-commerce initiatives, for example. And so earnings per share, $1.59, up 7% year over year, even though there was a negative currency impact, about 6 cents per share. And, they're showing some really positive, this, by the way, I should note that all of this really surprised, at least what the analyst estimates were, beat them pretty handily. And their stock was up 22% before we came down. And
wow.
Another thing I wanted to mention too from their report was that they have been pretty active with their share repurchases for the past few quarters. So for this one, they repurchased about 4.7 million shares, previously 9.4, and the other quarters, the 3 quarters before that.
So this is turning out to be a really good move.
Exactly. So in all, in the past 4 quarters, companies repurchased about 20 million shares. They reduced their shares outstanding by about 10%. So during this tougher climate for them, they've been focused on making sure that they're kind of maximizing where possible those returns to their shareholders. Very positive. And specifically for their business, some of their offerings, their shoes accessories did really well. Their e-commerce, like I mentioned, double-digit growth. In their international markets, especially with Asia, again, doing very well. And, that's actually really similar to what Coach reported. They had that acquisition, and their shoes were doing really well. Some of their other accessories did very well, and their e-commerce efforts in Asia markets were big for them. So it just mirrors very closely, and you can see that. And it's really interesting. During the earnings call, CEO John Idol brought up a really interesting point. Brought up a really cool point, where from their e-commerce efforts, they noticed how in mobile and online, their offerings have expanded, but customers were flocking a lot to footwear, and having data like that has made them realize, okay, that's become a really popular category for us, and now they're thinking about how that can apply to their actual physical retail stores as well, and hopefully benefit from some of that data they get from those online efforts.
Cool.
So, in terms of near-term, catalysts, they have their major spring collection planned, and big picture, we see that despite overall lower retail foot traffic during the holiday season. I think retail metrics had it down about 6% or over 6%. Not all companies have been losers. Macy's and some of these other companies have been struggling, but we know that JCPenney, for example, here, Coach, Michael Kors, they're kind of taking share in a way. And obviously, it's not like across the entire sector everybody has been struggling with some of these issues in terms of, the unseasonably warm weather or the currency fluctuations hurting tourist spending, for example. So, even though the stock's up 22% for the day, it's still trading at just 11 times trailing 12 months earnings.
The market's 20,
and I should add that Coach, coincidentally, is up about 23% since it reported January 26th. Again, really similar.
Right.
And so if management can really continue to execute with, these popular offerings, they have an attractive e-commerce online shopping model as well, and their footprint expansion, they increased 20% store count. That's going to continue. Hopefully, they're seriously worth consideration in terms of like a nice value play.
Cool.